Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. Coming up on today's program, South Africa to open up economy from June under eased lockdown regulations. Tunisia's central bank keeps key interest rate unchanged at 6.75%. And Zimbabwe imposes bank transfer limits to stop currency rout. But first, the markets. And major markets here in Africa were trading mixed at intraday, and that's between South Africa and Nigeria. The JSE index in South Africa shed in 1.18%, while the market in Nigeria rose 0.73%. Egypt's EGX 30 closed the week unchanged on Thursday, while Kenya closed negative on Thursday. And major markets in Gulf region, the stock markets in Dubai and Abu Dhabi closed the week negative on Thursday, with Dubai's index shaving off 1.16%, while the Abu Dhabi index lost 0.35%. Other major Middle Eastern bourses, including Saudi Arabia and Qatar, remained closed for the Eid al-Fitr holiday. And European markets retreated on Friday morning as escalating tensions between the U.S. and China pushed back on the week's positive sentiment amid the reopening of economies across the continent. For details of that and more, let's talk to Ulrich. Hello, Ulrich. Good afternoon. Well, the markets were heading south this Friday, basically across the board. What is the sense you're getting there? Are investors nervous, after all, not as optimistic about corona lockdowns being lifted, or worried about Chinese-U.S. tensions? Or does it look more like a breather?
Well, you mentioned the Chinese-U.S. tensions, that might be playing into it there, but I think it's more of a breather. Talking to market participants here, one trader, for example, said that he saw it just as a breather. I mean, you have to see where the markets were coming from these past few days. It's just been a tremendous upsurge, despite all those risks out there. Investors investing across the board when you take the week as a whole. Sure, there were daily favorites, but usually all the shares got a bit of the investor attention as the week passed, and some had tremendous surges. And people here are a little nervous that there is that kind of optimism, exuberance almost, because one of the risks, of course, besides U.S.-China tension and what it involves for trade, possibly also on the political security side, is bank loans. There's so much money that is being pumped into the system, some of that in bank loans and some of that to companies who might fail in the end. And what does that bring us? Perhaps a new banking crisis, a new financial crisis. So this is the kind of thing that's also on the people's minds. Uneasiness in the background, not translating into share prices at the moment, but people are also keeping this in mind.
Okay, let's look at the car industry. A lot of news coming in. Volkswagen is stepping up investment in China and e-mobility there, injecting more than 2 billion euros, while Renault is slashing nearly 15,000 jobs. Tell us more.
Yes, VW is seeing China as its biggest market, and it is the biggest car market in the world. And from VW's sense, from its perspective, it makes sense to inject this money there. One part goes to a battery project, the other to a joint venture, which VW is already involved in, but in which it wants to raise its stake in order to get a part of the pie when things get going again. And Herbert Diess, the Volkswagen CEO, has very clearly said that he sees Volkswagen's goal to become nothing less than #1 in electric mobility, and also have batteries as a core competence of the company. Totally different picture, news-wise, at least today. #3 world car maker Renault, slashing 15,000 jobs. This part of the strategy that it announced to produce fewer cars and make more money with them than before, and produce just much more efficiently. It needs less people, but it remains to be seen how this sits with the French government. President Emmanuel Macron, he pegged 8 billion to support the French industry, but for example, the aid that he's foreseeing for Renault, he's pegging that to agreement on jobs with the unions, and this 15,000 jobs slash doesn't sound at all like it's the grounds for an agreement.
All right, Ulrich, it's been an exciting week. Give us a brief wrap, and what are some of the highlights for next week?
I think one highlight for this week was the EU's 750 billion euro recovery program that it plans. It's a controversial program. It needs a unanimous vote in the European Council, that is with all the heads of government and state. And at the moment, it's going to be a tough ride for Ursula von der Leyen, the EU Commission President, to push this through. Another highlight for me, Lufthansa, the back and forth on the German government's program, the EU wanting concessions from Lufthansa, and Lufthansa finally, that's the situation at the moment, withdrawing from seeking the government aid because it doesn't want to make those concessions. And Lufthansa is going to be another topic that spills into next week. One of the highlights, because the Deutsche Börse here, the operator which operates the trading here, will decide who's still valid for the DAX, the top league of the German stock market. And Lufthansa, with all the value that it's lost over the corona crisis, is likely to fall out of the top league of German companies. It's been a founding member. It's been in there since 1988. Next week could spell the end of that. And another highlight, the ECB meeting. Expect questions for President Lagarde on that EU Constitutional Court ruling criticizing the ECB for its bond buying.
All right, Ulrich, we'll sure keep an eye on those for next week. In the meantime, catch a breath and say, thank God it's Friday. Enjoy the rest of the weekend.
Thank you.
All right, in the UK, lenders have granted around 1.5 million payment holidays on credit cards and personal loans for customers impacted by the COVID-19 outbreak and lockdown. According to fresh figures released by banking lobby group UK Finance, there are also other market-moving news on the wire. And of course, Juliana will speak to us about those. Hello, Juliana. Good afternoon. Well, let's look at the British manufacturing sector. Of course, manufacturers are planning to make tens of thousands of workers redundant after a worse than expected slump in orders prompted by the pandemic that has left many firms struggling to survive. How worrying is this situation for citizens and, of course, the government?
Good afternoon, Chimeze. It's very worrying, particularly for the unemployed or those who are furloughed and are hoping to get their jobs back as soon as people start working full-time here in Britain again. This information has been gathered by the manufacturing body Make UK. They did a survey of about 224 manufacturers, and they found that a quarter of them said that as soon as the government furlough scheme is up, they'll be releasing some staff within 6 months. And this is a major concern. We're still waiting to hear from the Chancellor Rishi Sunak, perhaps later today, about his final announcement with regards to the furlough scheme. The government have made it pretty clear that it cannot go on much longer. It's already cost them £15 billion. It's expected to cost them about £80 billion. And what the concerns are really is as soon as the government start asking their employers to start topping up their employees' wages, then they'll just say they can't keep them on. We've already seen this in the airline industry. BA, Ryanair, EasyJet have announced mass cuts, and even though they're getting their employers' wages paid already. So it's very concerning, but nothing is set in stone at the moment. But of course, we've got a lot of people with their ears to the ground, and the ears to the ground are saying that there's going to be mass jobs cuts before the end of the year here in Britain.
And in another twist, British Airways is proposing to outsource work being done by at least 450 employees it is making redundant. What details do you have on this?
Well, not much details, but BA are in hot water again, particularly with criticisms and the Labour opposition party. BA are another massive company here in the UK that are relying on the government to pay their wages. Well, it's the government that are paying it, but the taxpayers, it's coming out of taxpayers' money. They've accepted a £300 million loan from the Bank of England, and it's costing the taxpayer about £35 million to keep their staff on this furlough scheme. BA already announced a couple of weeks ago that they will be reducing their staff count by about 12,000. And what's been found out is that 450 jobs within Heathrow have been outsourced to individuals. Now, 450 may seem like a small amount, but people are pretty ticked off that they'll be paying individuals the full amount, whereas they're putting those who should be working in that sector on 80% of their pay. And people are saying it's just not on, that BA have received hundreds of millions of pounds from the government, and the fact that they're being furloughed and they're still saying that these job cuts are going on, it's not good enough. And as well, of course, doing this outsourcing of their staff, which is seen as pretty cheeky, and Labour are asking the government to really crack down on the BA owner, IAG.
All right, let's turn to the markets. Bring us up to speed with intraday numbers and, of course, some expectations for next week.
Well, it was a good start for a short week for the FTSE, but it seems like we'll be heading into the weekend in the red. The all-share at intraday is down 0.98%. The FTSE 100 also down by 0.97%. And the FTSE 250 is down by more than 1%. In currencies, the pound also down on the dollar by 0.02%, down on the euro by 0.47%, and down on the Japanese yen by 0.38%. Here in Britain, I think everybody, including myself, Chimmy, is looking forward to the lockdown measures being eased from Monday. So from Monday, people will be allowed to gather in larger groups of people outside of their households by up to 6. We're also going to see the start of showrooms opening and garden centres, so the economy is going to get a further kick, especially because we had some really abysmal car sale numbers over the past couple of months. Let's see if people are going to be rushing into car showrooms trying to get a hold of a brand new car. I don't suspect so, but the government will be hoping so, because they need the economy to start kicking again. So next week there'll be more people buzzing around in London and around the rest of the country.
Well, we'll have to see how that goes. And of course, perhaps people will have a lot of money in their pockets to actually go to the the showrooms there. Enjoy the rest of the weekend, Juliana.
Thank you, Chimay.
All right. And stocks in Asia Pacific were mixed on Friday as investors watched for market reaction to China's controversial national security law for Hong Kong that was approved on Thursday. Mainland Chinese stocks edged higher on the day, with the Shenzhen component up 0.86% to about 10,746.08, while the Shanghai Composite gained 0.22%. Hong Kong's Hang Seng Index dipped 0.7% as of its final hour of trading. In Japan, the Nikkei 225 declined 0.18%, while the Topix Index also shed 0.87%. South Korea's Kospi finished its trading day slightly higher, and Australia S&P/ASX 200 declined 1.63% overall. The MSCI Asia ex-Japan Index dipped 0.17%. And stock futures slipped slightly early on Friday morning as traders braced for an upcoming news conference on U.S.-China relations from President Donald Trump. Dow Jones Industrial Average futures dipped 84 points. S&P 500 futures and Nasdaq 100 futures also pointed to a negative open. Futures also fell after Salesforce issued disappointing guidance for the second quarter. The company expects earnings ranging between 66 cents a share and 67 cents a share. Tensions between China and the U.S. have risen lately as Trump criticizes the Chinese government's response to the coronavirus outbreak. And away from the markets and back here on the African continent, South Africa will allow most economic sectors, including mining and manufacturing, to fully resume operations from next month as the country further eases coronavirus lockdown regulations. Africa's most industrialized economy has been largely shut since a nationwide lockdown began in late March. South Africa has reported 25,937 cases of the new coronavirus, with 552 deaths. Some high-risk businesses such as hotels, lodges, hair salons, and sit-down facilities at restaurants will, however, remain closed. The government has permitted sale of alcohol for home consumption from June. Limited domestic air travel has also been permitted. The mining industry, which has recorded 320 cases of coronavirus so far, is among the industries that will return to full capacity. And when we come back after the break, we'll talk about responses to the fight against COVID-19 effects by central banks in sub-Saharan Africa. Do stay with us. We start off this segment in Zimbabwe as the central bank has imposed limits on the amounts banks may transfer via a payment platform with 2 million users as it tries to curtail illicit transactions and money laundering that it claims contributed to a currency rout. In a letter dated May 27, the central bank's financial intelligence unit ordered ZimSwitch Technologies, the owners of the ZimSwitch instant payment interchange technology, Technolog system, to implement daily and monthly limits of 20,000 Zimbabwe dollars and 100,000 Zimbabwean dollars each with immediate effect. Zipit is used by mobile phone users to send money to each other. The central bank says the curbs would remain until safeguards were in place to minimize the risk of money laundering. And Tunisia's central bank kept its key interest rate unchanged at 6.75% after cutting the rate by 100 basis points in response to the coronavirus outbreak in March. According to the bank, the current account deficit declined during the first 4 months of 2020 to 2.8% of GDP compared to 3.6% during the same period in the previous year, a result mainly due to a decrease in trade deficit. The bank calls for increasing exports, especially in light of expectations of a significant decline in tourism revenues as a result of the coronavirus crisis. And more Kenyans are starting to operate small businesses out of the boots of their cars to make ends meet as the coronavirus crisis has hit jobs and the economy. The East African nation has 1,286 confirmed cases of the COVID-19, and the disease has devastated crucial sectors of the economy like tourism and farm exports. Let's watch this.
Boniface Mbugua, who lost his catering job, drives his car to markets to sell food to traders to make enough money to feed his children. Kenya has 1,286 confirmed cases of COVID-19, and the disease has devastated crucial sectors of the economy like tourism and agricultural exports.
My boss dropped me from work and I had to find something to do for my family since our hotels are not open at the moment. And with that forthcoming, I had to come here and start a business, start something small for my kids and something that I can get a few shillings for my family.
Those problems have spilled over into the transport sector, where Stephen Waweru's Tours and Travels business has struggled to get any passengers. This has forced him to start hawking avocados and bananas from the boot of his car. Waweru intends to continue with this venture even post-COVID-19 restrictions.
If Corona ends, we go back to our job. We will still do this job because it has helped us to get some food, our daily bread, and we appreciate.
Others like Anne Njeri, who used to work as a church administrator, says selling bananas from her car next to a busy highway is even more lucrative.
And South Africa's first black female winemaker watched anxiously as the worst drought in a century scorched vineyards in Cape Town, challenging her pledging businesses Aslan Wines. After surviving it, Bessel business recovered and was poised for growth this year until the new coronavirus pandemic struck another blow, threatening a bitter harvest as domestic and export sales tanked during 9 weeks of stringent lockdown. And the Central Bank of Nigeria is the latest central bank in sub-Saharan Africa to announce its monetary policy rate decisions as the world grapples with the coronavirus pandemic. The bank cut its main lending rate by 100 basis points to 12.5% and left every other parameter unchanged. Joining me now to look at sub-Saharan Africa Central Bank's responses so far to the fight against the effect of COVID-19 is the CEO at Core Street Analytics in Nairobi, George Bodo. Good afternoon. afternoon, Mr. Bodo. Thank you for joining us. Well, in the last couple of weeks, central bankers in sub-Saharan Africa have sat to deliberate on the monetary policy environment in the fight against COVID-19. South African Reserve Bank slashed repo rates by 50 basis points. Ghana left its rate steady at 14.50% and cut its policy rate by 225 basis points. Kenya left its rate unchanged at 7%. And just yesterday, Nigeria cut its benchmark rate by 100 basis points. What strikes you most in these moves by African central banks?
The most striking thing is the fact that there is a general belief that the best way to fight a public health crisis is to print more money. So that's the most striking thing. And that's why you're seeing a number of central banks in sub-Saharan Africa are moving towards what we call the monetary policy easing. And you've seen, I mean, you've counted a number of central banks that have gone this route, latest being the Central Bank of Nigeria yesterday. I think the key thing here is that as most African countries in the region realize that there is very limited fiscal space to respond to the current crisis. So the next best is to ease the monetary policy stance. And that's what you're seeing. And for instance, Kenya, for instance, yesterday when they met, 2 days ago when they met, they left the benchmark rate unchanged. And this is because it came off the back of two quick-fire moves which saw them cut the policy rate by about 150 basis points in two consecutive meetings. So the argument was, look, we've done these two quick-fire moves, let's give it time to seep into the economy. And that's the basis why they moved, this is why they decided to hold the rate 2 days ago already.
Now, on a broader scale, how do you see most African countries navigating this challenging time, especially given their vulnerability with volatile commodities?
I think that on the broader side, by African governments, you're likely to print money because they don't have, as I say, they don't have any fiscal space to. I give an example. South Africa, just a couple of weeks back, unveiled almost $29 billion economic stimulus package. And part of this was, part of it was financed by borrowing from developed finance institutions, and part of it was reallocating the budget. But a good portion of it was that the central bank would also buy government-issued treasury bonds. By the way, we've seen Ghana also go this move. The central bank, the Bank of Ghana has so far bought treasury bonds worth almost $1 billion. And so you are likely to see this trend of central banks. But then in Kenya, the central bank also is almost going this way. We've seen insinuations that they're likely to unveil some form of an SME guarantee scheme. But the best way, because Kenya, for instance, is a country which has zero fiscal space to respond to the crisis. And one of the calls I've made is that the central banks need to print money for the government to respond to this. Thank you.
All right, thank you very much, George Bodo. George Bodo is the CEO at Call Street Analytics in Nairobi. Thank you for your time. And on that note, we draw the curtain on today's edition of the program and, of course, for the week. Thank you for watching. I'm Chimezie Obi Iwagu.